Do you want to start earning from stocks? Welcome to an exciting journey into the world of investing. Today we're going to unravel the mystery of the stock market, an arena where fortunes are made and dreams are realized. Imagine owning a piece of a company you believe in, sharing in its successes, and reaping the rewards as it grows. That's the power of investing in stocks. From the comfort of your home, you can participate in the global economy, supporting businesses from different industries and sectors. We'll explore online platforms that make it easy to get started, even if you're a novice. We'll discuss how to buy and sell stocks, and how to make informed decisions that align with your financial goals. We'll also share tips and strategies, specifically tailored for beginners. So, are you ready to embark on this journey of financial empowerment? Stay tuned as we dive into the process of investing in the stock market. Before you start investing, it's important to understand what stocks are. Simply put, stocks, also known as shares or equity, represent ownership in a company. When you buy a stock, you're purchasing a piece of that company. You're essentially becoming a part owner. But why do companies issue stocks? Well, companies issue stocks to raise money. They use this money to fund new projects, pay off debt, or expand their business. When you buy a stock, you're essentially providing the company with the capital they need to grow. In return, you get a claim on part of the company's assets and earnings. Now, there are two main types of stocks, common and preferred. Most of the stocks that people buy are common stocks. These give shareholders the right to vote at shareholders' meetings and to receive any dividends the company decides to pay out. Preferred stocks, on the other hand, don't come with voting rights, but they do have a higher claim on the company's earnings and assets. This means if the company were to go bankrupt, preferred shareholders get paid before common shareholders. So, how do stocks work? Well, the price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. The potential returns on your investment come in two forms: dividends and capital gains. Dividends are a portion of the company's earnings that are paid out to shareholders, usually on a regular basis. Capital gains, on the other hand, come from selling a stock for more than you paid for it. Investing in stocks can be a great way to grow your wealth over time, but remember, it's not without risks. The price of a stock can go down as well as up, and there's no guarantee you'll get back what you invested. Now that you understand what stocks are, let's move on to the process of investing. Investing in the stock market involves a series of steps. Let's walk through them together, shall we? The first step is research. Before you even think about buying stocks, it's crucial to understand the company you're investing in. Look at their financial health, growth potential, and the industry they're in. Are they innovating? Are they reliable? Are they profitable? Remember, you're buying a piece of this business, not just a stock, so it's essential to know what you're getting into. Next, you'll need to open a brokerage account. Think of this as your gateway to the stock market. There are numerous online brokerage firms out there, each with its own advantages and disadvantages. Some offer low fees, others have great customer service, and others provide extensive research tools. It's important to choose one that aligns with your needs and preferences. Once you've opened your account, it's time to fund it. This is where your investment capital comes in. It's crucial to only invest money that you can afford to lose. The stock market is inherently risky, and while there's potential for high returns, there's also a chance you could lose your investment. So, only use money that you don't need for immediate expenses or emergency savings. Now comes the exciting part: choosing your stocks. There are thousands of companies listed on the stock exchanges, so choosing can be daunting. But remember the research you did earlier? This is where it comes in handy. You'll want to look for companies with strong financial health, good growth potential, and a solid track record. And don't forget about diversification. This means spreading your investments across different industries and company sizes. This helps to mitigate risk and create a balanced portfolio. Once you've chosen your stocks, it's time to make a purchase. This can be done through your brokerage account. You'll need to decide how many shares you want to buy and at what price. Some investors prefer to use market orders, which buy at the current market price, while others prefer limit orders, which only execute if the stock reaches a certain price. The choice is yours, but remember to be patient and avoid making impulsive decisions. Finally, after your purchase, it's important to monitor your investments. This doesn't mean checking your account every hour. In fact, that can lead to stress and poor decision-making, but rather keeping an eye on your stock's performance and the overall market trends. You'll also want to review your investment strategy periodically to ensure it still aligns with your financial goals. Remember, investing is not a one-time act but a continual process of research, buying, monitoring, and selling. It may seem complex at first, but with patience and persistence, you can navigate the stock market and potentially reap the rewards of your investments. As a beginner, there are a few tips that can help you on your investing journey. First off, start small. While the glitz and glamour of big returns can be tempting, it's crucial to remember that investing is not a get-rich-quick scheme. It's better to dip your toes in the water and learn the ropes before diving in head first. Start with a small amount that you can afford to lose, then gradually increase your investments as you gain more confidence and experience. Next, diversify your investments. Don't put all your eggs in one basket. Investing in a range of different stocks can help spread risk and increase the chances of earning a return. It's like having a safety net. If one stock performs poorly, others might perform well and offset the loss. Another important thing to keep in mind is patience. The stock market is not a sprint, it's a marathon. Prices fluctuate daily, and it's easy to panic when things seem to be going downhill. But remember, investing is a long-term game. Don't get swayed by short-term market volatility. Stay the course, and over time your investments are likely to grow. Lastly, understand the risks involved. Investing in the stock market is not without its risks. Prices can go up as well as down, and there's always the possibility of losing money. So, before investing, take the time to understand these risks. Do your research, read up on the companies you're interested in, and don't hesitate to seek advice from financial advisors. Remember, knowledge is power. The more you know about investing, the better equipped you'll be to make informed decisions. And while there's no surefire way to guarantee success, these tips can certainly increase your chances of a positive outcome. With these tips, you're more prepared to make informed decisions in your investing journey. Investing in the stock market can be a rewarding experience. We've journeyed together through the basics of understanding stocks, the steps to start investing, and some essential tips for beginners. Now, as we wrap things up, let's take a moment to revisit the key takeaways from our discussion. Firstly, we discussed that the stock market is a marketplace where buyers and sellers trade shares of publicly listed companies. The value of these shares fluctuates based on a variety of factors, including the performance of the company, the state of the economy, and investor sentiment. We also explored some reliable online platforms where you can start your investment journey. These platforms are designed to provide you with the tools and resources you need to make informed decisions about your investments. In the steps to start investing, we emphasize the importance of setting clear financial goals, understanding your risk tolerance, and diversifying your portfolio. It's essential to remember that investing is not about making quick gains, but about growing your wealth over time. We also shared some tips for beginners, such as starting small, investing in what you understand, and not being swayed by market rumors or hype. It's crucial to stay disciplined, patient, and focused on your long-term goals. In conclusion, investing in the stock market can be empowering and rewarding, but it also requires knowledge, patience, and discipline. So I encourage you to take the first step in your investing journey. Start small, learn as you go, and remember to invest in a way that aligns with your financial goals and risk tolerance. Lastly, keep in mind that the road to financial independence is a marathon, not a sprint. Continue to educate yourself, stay informed about market trends, and make adjustments to your investing strategy as needed. Thank you for watching. Remember, the stock market is not a get-rich-quick scheme. It's a platform for long-term wealth creation. Happy investing!